All right, let's just jump right into this. Welcome to The Explainer. Today, we're looking at one of the absolute most fascinating paradoxes sitting on Wall Street right now. I'm talking about Figma. This is a business that is experiencing just blistering, totally undeniable growth, and yet its stock price is languishing way below its initial public offering highs. So you might be wondering, how on earth does a company fire on all cylinders internally but completely get punished by the market externally? Well, we're going to dig into the exact data, the SEC filings, the whole shebang, to give you a really clear, balanced perspective on whether this software giant is a fallen angel or, just a value trap. To figure that out, we've got a pretty straightforward roadmap today. We'll walk through their business performance and growth, take a look at the current market valuation and sentiment, and then lay out both the bull case and the bear case before we wrap it all up with a final verdict to help you form a sharp investment view.
So let's kick things off right at the foundation with Section 1, Business Performance and Growth. Because, before we can even think about judging the stock, we really have to look at the underlying business and the hard financial data.
And honestly, what is truly staggering here is just the sheer scale of it all. In fiscal year 2025, Figma posted a massive $1.055 billion in revenue. That's a 41% increase year over year. This isn't just some niche design tool anymore. Figma has firmly established itself as the go-to system of record for product teams globally. It's literally the glue holding designers, developers, and product managers together.
But here is where the massive disconnect happens. You immediately have to juxtapose that roaring business success with its completely beaten down stock price. Figma went public back in July at $85 a share. And recently, even after a nice little post-earnings bump, it was trading around a 7-week high of just $22. That is a staggering drop. It was basically dragged down by this much broader sell-off across the whole software-as-a-service sector, especially after that abandoned merger with Adobe.
So you've got this business that's growing, but a stock that's tanking. You're probably thinking, is the growth slowing down? Actually, no, not at all. Just look at the year-over-year revenue growth over the last 3 quarters. Q3 was at 38%, then Q4 accelerated to 40%, and then in Q1 of 2026, Figma delivered a massive $333.4 million revenue beat, accelerating all the way up to 46% growth. Operationally, they are just hitting it out of the park. To put that into perspective for your own portfolio, seeing a 46% growth rate at a billion-dollar run rate, that is incredibly rare in today's SaaS market. It absolutely proves dominant execution at scale.
And that Q1 outperformance actually gave management the confidence to upgrade their guidance. For Q2 of 2026, they're now targeting up to $350 million in revenue, which implies about 40% growth. And for the full year of 2026, they bumped their whole outlook up by a solid $55 million. So now they're looking at a range between $1.422 and $1.428 billion. That represents roughly 35% growth. So the fundamental engine here isn't just cruising, it's absolutely roaring.
Which brings us to Section 2, Market Valuation and Sentiment. We've seen the revenue is surging, but how is Wall Street actually pricing these financial results right now?
Let's break down the multiples. At around $22 a share, which, by the way, popped over 9% on that strong Q1 earnings report, Figma is sitting at a market cap of roughly $8.9 billion. What this means is that the stock is trading at a forward price-to-sales ratio of about 8.5 times 2026 analyst estimates and just 7.2 times 2027 estimates. Now, in the SaaS world, finding a company that boasts 80% gross margins and 35% top-line growth, but is trading at that kind of multiple, that is exactly what value-conscious growth investors are hunting for.
All right, that leads us perfectly into Section 3, the bull case. Why are the optimists out there scooping up these shares? Let's dive into the key catalysts driving that optimistic investment thesis.
The absolutely crucial data point driving the bulls right now is this number, 139%. That is Figma's net revenue retention rate for customers spending over $10,000 annually, and it's their highest level in 2 whole years. For SaaS companies, this metric is literally the holy grail. It means that even when you account for customer churn, their existing enterprise customers are spending 39% more this year than they did last year. That is massive. So how exactly are they getting these customers to open up their wallets and spend more? Well, they're successfully expanding their platform way beyond just standard UI design. Figma currently has 690,000 paid customers, and they are cross-selling a massive suite of new products to them. You've got FigJam for whiteboarding, Dev Mode for developer handoff, Figma Slides for presentations, plus they have Figma Make for AI prototyping and Figma Weave for AI media generation. They're basically capturing entirely new budgets all across the product development lifecycle. On top of that, the bulls absolutely love Figma's strategy for AI monetization. In 2025, they rolled out AI across all their seats. But starting in March of 2026, Figma is strictly enforcing AI credit limits. When users hit their cap, they are successfully being nudged to opt in to pay-as-you-go plans or just buy extra subscriptions outright. This credit-based pricing model gives Figma a really clear, direct path to monetize their heavy AI users.
But of course, no investment is a sure thing. Let's pivot objectively over to Section 4, the bear case. We need to focus on why the broader market still hesitates to fully jump in on this stock.
You really have to consider the double-edged sword of artificial intelligence here. While the bulls see AI as this incredible revenue driver, the bears are looking straight at the balance sheet. In their SEC filings, Figma explicitly warns that their AI investments are going to negatively impact gross and operating margins in the short term. Because, running large language models and media generation pipelines, that requires immense technical infrastructure. AI inference costs are high. And if Figma can't price their AI features perfectly to offset those really volatile computing costs, well, profitability is inevitably going to take a hit.
But honestly, the biggest fear holding the stock back is something called seat contraction risk. Think about it. Figma's entire business model relies on charging per seat per user. If AI tools like Figma Make and Figma Weave become too good, they might allow a company to do the exact same amount of design and development work with half the human workers. And if companies need fewer designers, they buy fewer Figma seeds. That right there is an existential threat that could actually shrink Figma's total addressable market over the long term.
So, we've got accelerating growth and cheap multiples on one hand, and then the looming margin and market share threats of AI on the other. Let's move to Section 5, the final verdict, and synthesize what this all means.
I think this quote from financial analysts really hits the nail on the head and captures the current tension perfectly. It says, while there remains a narrative that it will be an AI loser, Figma continues to demonstrate that AI is driving growth. See, Wall Street has aggressively tossed Figma into a bucket of software companies vulnerable to AI disruption, and they've heavily punished the stock for it. But Figma's stellar Q1 reality, with that 46% revenue growth and accelerating product adoption, proves that, at least for right now, AI is acting as a massive tailwind for the business, not a headwind.
Which leaves us with the ultimate question you have to answer if you're evaluating this stock for your own portfolio. As we watch these incredibly fast-evolving technologies, will AI be the engine that successfully monetizes users and rockets Figma back up to its $85 IPO valuation? Or is it going to be the disruptor that makes product teams so efficient they just don't need to buy as many software seats anymore? The data shows a wildly thriving business today for sure, but the market is very clearly asking you to place a bet on the future of human-AI collaboration.